Welcome to the Bitcoin Macro War Room, where we jack into the market mainframe and derug the narrative. Plug into the pipes, M2, DXY, inflation, momentum, fresh prints, CPI, ISM, payrolls, rates, truth by facts, not vibes. Tweets and news rundown, meme to policy, curated, timestamped, tradable.
Welcome, you've got mail.
Copium not included. Roll the tape, let's invest like it's 1999, but with better charts.
Let's go. I'm ready to rock and roll. I hope you are too. It's Friday, my favorite video of the week, the macro war room for Bitcoin. I have a special one on deck this week. I have a couple of new charts. We'll take a look at the institutional research, which is the most important part, in my opinion. And then I have a ton of tweets and news to get into. It's been a wild ride for Bitcoin this last week in terms of price appreciation. So let's just jump right into it because we have a ton of stuff to go over this week. Even with the government shutdown, we still have a metric F ton of data to go through. So let's start off with the charts because I think there's some interesting things to take a look at here. And I updated this a little bit. I changed the theme. We went dark mode for this. So most important thing to note for the global liquidity is you can see up here in the top right that it's declined out of this breakout box. It's now back below the neckline. And shockingly enough, it's actually underneath the 89-day EMA for the first time since all the way back in 2024 or end of 2024, early January when it crossed under. So we could potentially see some more weakness. And that is one of the themes for this video. And I'll get into that in a little bit. The regime tracker here on the bottom is in expansion, which is really good, meaning the business cycle is hopefully finally starting to turn up. And I think we'll be heading back towards the top of this channel, which should help price accelerate and go for the next leg up. So that's pretty much it. We're still risk on in terms of global liquidity. This only goes risk off when there's some invisible EMAs here, shorter EMAs that have to cross the 89-day before this actually goes risk off. So if we bounce here and head higher with global M2, I think that's going to be really good. Again, the story this year has been China M2 pumping the most out of all the countries. US has kind of been lagging. And we'll take a look at the FedNet liquidity here in a couple of minutes. But I have some extra charts this week. So let's dive into them. We're going to start off with my favorite, which is the McRib macro chart. And while this could be perceived as kind of funny, kind of stupid, it does give you a taste for how corporations are looking at consumer retail sort of sentiment in terms of buying their products. And you can see that McRib, every time it makes a return, Bitcoin goes on a sort of monthly pump, and the McRib has just come back. So pretty straightforward, but I thought kind of funny, kind of ominous. So we'll see if this, 3 for 4 turns into 4 for 4 here with Q4 now aligning to be sort of strong, but I do want to temper expectations a little bit, keep your pants on as usual. So anyway, let's move on to the next chart. This is Bitcoin versus gold. Now, gold here is offset by about 8 months, but you can see that the correlation has been stark. Yes, there have been moments where it has decorrelated for numerous different reasons, but generally gold leads Bitcoin as a debasement trade just by 8 to 9 months. You can take a look at this yourself and sort of overlay it if you want to get the trading view indicator to offset things yourself. It's just called offset. So type offset into indicators and you'll be able to pull this up. But if this correlation holds, this means that Bitcoin could potentially go to, 180K by, this would be October. I don't think that's going to happen. I think that's a little too juicy, but the theme here stands, right? They're correlated. Gold kind of front runs the price. We'll see if this actually plays out or not, but I thought it was an interesting chart. And second to this chart is the actual ratio. So if you look at Bitcoin over gold and you zoom out, this is a monthly view, you can see this beautiful ascending triangle or ascending wedge, whatever you want to call it. Let me move my camera here so you can see it a little bit better. But this is a monthly view, and we've been 1, 2, 3, 4, 5, 6 times tagging this sort of neckline at 37. I think once this breaks, if it does break to the upside, that is when you'll see exponential Bitcoin returns potentially and a very strong next leg higher. So I'm definitely keeping an eye on this. This is a chart to watch. Obviously, this is a monthly chart, so it's going to move very, very slowly, but something to keep an eye on in terms of the ratio. And a new addition to this weekly video, I had some comments asking me, how do I look at short-term price? And I don't necessarily spend too much on short-term price. This is the one view that I do look at. The only time I really use this is when I want to potentially add leverage to my position. So IBIT calls or something of the sort. And you can see here, I use a sort of DMARC style indicator. You can't use DMARC explicitly because the guy copyrights it. So if anybody puts anything on TradingView with DMARC in it, it automatically gets pulled down. And take that for what it's worth. The actual DMARC indicator costs, I think, hundreds or thousands even of dollars. But this is generally how I look at it. So you can see we've hit a short-term top with the new all-time highs, and we're looking at some chop solidation, for lack of a better word. And we'll see how this kind of plays out. But that's the charts for this week. Now let's take a look at the data breakdown. And obviously with the US government being shut down, no data has come out this week. And who really cares? There wasn't anything too important up for this week. Next week is going to be one of the most important weeks, I think, of October. You can see just the absolute metric insanity in terms of data from Tuesday to Friday, the most important being CPI, the PPI, retail sales. For me, the Empire State Manufacturing and the Philly Manufacturing is definitely an important one. And then you have unemployment and jobs related data on Friday. Again, this is all tentative in terms of Friday with the government shutdown, but we should be getting the rest of these numbers. So we'll have a big breakdown next week, but that's pretty much it. There was no data this week, so not much to talk about. So I have something special in store. But before we do that, let's take a look really quick at the Fedwatch. And this really hasn't changed. For the end of this month, it's pretty much a shoo-in that they're going to do another 25-point rate cut. For December, this has dropped just slightly to 83% in terms of a second rate cut. And then for January, we have a 33% chance of a third rate cut. And then for March, it's kind of no man's land. I don't really put too much stock into any of these numbers, but you can see this is it for March. And I was blocking the view, but this is it for January. And then obviously December, it's still pretty much a shoo-in. So we'll be getting 2 more cuts before the end of the year from Mr. J. Powell. And don't forget that J. Powell's tenure is up and he will be replaced by someone who is going to be insanely dovish, in my opinion. We'll see who that actually ends up being. There's a couple of front runners, but nothing too sure or locked in just yet. So with that out of the way, before we look at the system, I have something a little bit special. I think I'll probably be doing this just because I always have a ton of things in my head going into these videos in terms of what I want to talk about. And I figured, why not put it down on paper, have some notes, and then if there's anything extra that I want to call out, this will be a good place to do it. And since we didn't have any data this week in terms of economic releases, I did want to pull something out of the institutional research that I pay for that I thought was very interesting and that I wanted to call out. Now, obviously, I can't share exactly what the numbers are or what the chart was, but let's just say one of the institutional research services I pay for are warning that things are overvalued in the stock market. And there is increasing probabilities of a correction, not a crash, but a correction. Correction meaning usually 10%, 15%, something like that. And we have stretched the valuations for the S&P. It's been an insane run since the April tariff lows. So that's something to look out for. Also, with Bitcoin hitting all-time highs like last week, it was insane to me how bullish everyone was. And that to me was a signal that we've probably hit a short-term top. I actually sold short-term calls against my base position as a hedge, which ended up working out perfectly. I don't normally do that because it's risky and I don't want to sell my main position, but there's strategies to get around that in terms of rolling and other things. But anyway, my notes here are that I think Q4 might actually surprise people. I've been super bullish going into Q4, so this is sort of a pivot for myself as well. It might be weaker than most people expect. Everyone is expecting a hyper bullish Q4, and Bitcoin generally tends to do what people least expect in the short term anyway. And I think that's true. Stock market, as I mentioned, is at all-time highs and super stretched out. Numerous indicators are stretched, and I will share what some of those are. Again, this is from the institutional research. So cash, which is AAII, cash allocation, is at the 10th percentile, which is very low, meaning investors aren't holding any cash. They're all in. When there's almost no dry powder left to buy dips, even small negatives can flip the tape because the marginal flow is more likely to be sellers rather than new buyers. Same thing for IG credit spreads. It's at the 1 percentile, which is extremely tight, meaning bond investors are demanding almost no extra yield to own corporate risk. It's complacency, basically. Spreads can't tighten much more. So the easy tailwind there is gone. If anything jolts the outlook, spreads widen and stocks usually sag with them. If you want to look at spreads yourself, you can look at it on the Fred website here. And this is where we are currently, 0.75. Very, very low. If you look over the 10-year, we are at, like I said, like 1% in terms of percentiles. So something to watch out for there as well. The earnings per share for the stock market is at the 97th percentile, which is very, very expensive. And stocks are priced for near perfection, whatever. High valuation doesn't time the top itself, but it shrinks the cushion. Any disappointment earnings guidance macro hits harder. And you can see that here in terms of the S&P earnings per share TTM forward estimate. You can see kind of where we're at. So last two, 3-month realized vol correlations are at 9th percentile, which is very low. Parts of the market are marching to different numbers, and low correlation regimes often precede recorrelation shocks where names start moving down together. This is the CBOE S&P 3-month vol index, which you can see here. Again, you can look at these numbers yourself. And then economic policy uncertainty is at 97th percentile, very high. So policy, fiscal, Fed, obviously with Powell leaving, election noise is elevated, mixed high uncertainty with high prices and low risk premiums, and the setup is fragile. So in summary here, fully invested positioning, right? No cash on the sidelines, tiny credit risk premium, IG credit spreads, rich valuations, narrow tape, high policy noise is a market that doesn't need a big catalyst to wobble it. It doesn't guarantee an immediate peak. This is important, but it says upside is limited and the tape is vulnerable to negative surprise. So when I look at these types of things, it's what is my risk to reward? And if I had 100% cash right now, would I be buying S&P? Absolutely not, because the risk is much higher than the reward. So take that for what you will. Hopefully that helps you a little bit. I'll probably be doing this for this video series, but leave me a comment. Let me know what you think. And let's get into the playbook and the system, probably what you're here for. So let's take a look. Let me move my camera here really quick so you can see 93% risk on, so a slight increase. What changed here was the regime tracker. So we're at a 1.0. Everything else has stayed the same. Most importantly, all the institutional research up here in gold is still bullish or extremely bullish. So nothing has changed in terms of the macro level research that I use. Everything is still positive. So let's take a look at some of these inputs. We'll look at the BTC versus DXY. Again, nothing changed here. And I mentioned this last week that this will probably not change for a long time until the cycle is over. So dollar is still suppressed. For a bull bear market MVRVZ, this is still bearish just because this has not flipped the MA yet. But I think if prices stay up here where they are, I think it probably will within the next week. So STH, same thing. This has been an amazing buying indicator for this cycle. Basically, when this goes risk off, that's where you want a DCA. And again, that definitely worked. So this is still bullish, which is good. For the bull bear cycle drift, again, still bullish and actually turning up slightly here, which is good to see. So all positive on the Western front. And we can take a look at the old dashboard really quick. I don't think there was anything here to call out that was too important, but let's take a quick look. So the Bitcoin macro heat phase is still sort of up, gearing towards the middle line. So the standard zero deviation there, Sharpe ratio is still going up. Nupal is still yellow, which is fine. IFP, my least favorite chart, still bearish. Again, nothing's changed in long-term holder, short-term holder for net position change, which is weird given the price increase, but whatever. For LTH, STH is just curling up a little bit. Market cap change, this has definitely pumped, which is good to see. And then outside of that, I don't think there was anything here really to call out. So that's pretty much that. Let's take a look at the liquidation maps for Bitcoin. So we're going to start off with the 2-week. And for the 2-week, you can see that there is a group of liquidations under current price. So anywhere from 119 to 116. So keep that in mind in terms of if we start cascading, that's probably going to be some of the short-term targets. For a month, nothing really too crazy. Again, the same sort of liquidation cluster. The only sort of scary one is at 108 to 107, but obviously we're very far away from that in terms of price. So nothing to worry about really just yet there. And then 3 months, same thing. It's kind of all over the place. Nothing too crazy to call out. So that's it for the liquidations. Let's dive into the tweets for this week because I got a lot of stuff here on deck. So we'll start up here with Vandel. Fed net liquidity looks to reverse higher. Liquidity drives markets, not headlines. I do like this. I think this is an ROC, so a rate of change. No, this is the raw number. So I don't necessarily agree with these kind of charts in terms of mean reversion. It could just keep going down, but it is something nice to look at. And I have something like this on my website as well. Feel free to use these. These are all free, but I have my own Fed net liquidity, which is just US based. So you can see the indicator here. And if we zoom into 2 years, yeah, we've kind of stalled out here and maybe are curling up for a next leg. We'll see, but you can track this live on my website if you're interested. So that tweet is out of the way. Again, I've been doing this every week. I've been seeing these all over my feed. They are so low IQ. I'm sorry, Killa. Respect to you, brother. But these time-based, the cycle is over because the last 2 cycles ended exactly on day 1065 or day 1066. These are just terrible takes. I've broken these down for the last 2 weeks, so I'm not going to spend too much time on this, but I did bookmark this for next year so I can revisit it just for laughs. Milk Road Macro, great account. If you're not following them, definitely give them a follow. They post great charts. This was an interesting one. I've never looked at this before, but this is basically comparing the Russell 2000, which is the small cap index, to Ethereum. And based on the chart, they move in lockstep. And this isn't surprising. Small caps are very sensitive to interest rates. Smaller cap companies need loans, need investment, need money. So they usually struggle when interest rates are high, and they massively struggle when interest rates are high and the regime is risk off. So Russell has been outperforming. You can see so has Ethereum recently. So if you're interested in ETH, definitely watch the Russell 2000 as well for a correlation play. And great chart here. Nothing much to say there. Again, another one of these. This is the week. 1,064 days. Bull market over because X days went by. Again, just a lukewarm IQ take. We'll bookmark this for, January, February of 2026. A great post here by Arnaud. I was studying other times in history when gold prices more than doubled in the reserve currency of the time, as they did in the past year. It's rare and almost a sign of profound loss in confidence in the existing monetary and political order going all the way back to the Roman Empire. And it often marked the transition from one era of power to the next, the fall of Rome, Spain's decline from a world power, the French Revolution and terror, the end of Bretton Woods, etc. Interestingly, it's often actually as much a cause as a sign of these episodes, as this is effectively a transfer of real wealth from the poor to the rich elites who protect themselves with gold, this being what ignites the political upheaval. If you haven't read or do not understand what a fourth turning is, we are in one. So I won't spend too much time on this, but go ask ChatGPT, explain to me what a fourth turning is and what it could potentially mean for Bitcoin, and then we'll revisit this. Definitely something everybody should know because fourth turnings are generally massive events in terms of tides shifting, and I think Bitcoin is the future and will be the next monetary reserve asset, but whatever, I don't want to go on a rant about this. Again, another one of these. Now, I love 4chan lore style, prediction style posts, so these are great. But again, this is another one of those 1,065 days has gone by. So that's the end of the cycle. I call BS on this. It is what it is. We'll have the receipts if I'm wrong or if I'm right at the end of the year towards Q1, Q2 of next year. Timothy Pearson here with another great set of charts. So Ethereum, NASDAQ to VIX analog. This is basically showing the recovery after the VIX in the NASDAQ and adjusted for Ethereum beta. Great way to look at the data. So this says that Ethereum basically has a ton of room to run higher, which I do tend to agree with. So that's it for the tweets for this week. I hope you enjoyed the alpha drop. Again, I try to put as much alpha as I can each week into a 20-minute or less video. Sometimes they go over, whatever. But I hope you enjoyed this. If you did make it with me this far, first of all, thank you so much for sticking around and watching. If you did enjoy the video, you know what to do. I'm not even going to ask you for it. And as always, I'll see you next week. Have a great weekend and take care of yourself. Cheers.